Today, we're speaking with Ryan Yonkman with Rice Dairy, LLC, a brokerage firm in Chicago. Ryan, welcome, and tell us a little bit about your dairy background and your work with Rice to this point.
Joel, thanks for having me. Quick background on myself, born and raised on a dairy, northern Michigan. Currently today still a partner in that dairy, milking around 1,200 Holsteins and growing. As joined the Rice Dairy team back in 2011, right out of school. Had interest in ag, but was trying to find my way as to what was going to be really my role in the dairy. So pursued this avenue of risk management, of which 8 years later, here I still sit, living in the suburbs of Chicago, working with dairymen all over the country through Rice Dairy on helping them manage their price risk, as well as our own family's dairy back home.
That's great. A new dairy program was just announced recently. Gets underway October 9, the Dairy Revenue Protection Program. Can you tell us a little bit about that?
Yeah, it's exciting times. It's the focus of why we're talking today. This new program really is another tool in the toolbox for dairymen, backed by the government to help them protect against unexpected milk revenue declines. Key word in there is milk revenue. Okay, this isn't just price coverage. This is price times yield, very similar to crop insurance, which most dairymen are familiar with and using. A couple highlights. So I've broken it up into kind of, I think, three troughs of what makes this program work, which to me is flexibility, availability, and cash flow. So on the flexibility front, and what makes this really appealing is they've created a program that's going to allow dairy farmers to protect on the price aspect of it, class 3, class 4, a combination of the two if they want, kind of a blend, or they have the ability to protect butter, fat, and components. So it's an either or, but they've also got the flexibility to, it's not just one and done. They can do some of their milk through the lens of class 3. They could do some of their milk in class 4 on a different piece of production. They can do components, especially think about those high yield Jersey animals. They've created really nice flexibility here for dairymen, as well as on the protection aspect. These guys have an ability to protect anywhere from 70% to 95% of their revenue. So just really nice flexibility on the what and kind of how much. The next tier here, availability. Huge aspect of this program, no production limits. Okay. Prior programs, I think a lot of dairy we've talked to thus far, look at this and say, that's all, maybe it's for a smaller dairy or there's tiers, no production limits. So this program is built for any size dairy, whether you're producing 200,000 pounds or 20 million pounds. Dairies have an ability to come in here, utilize this program on the amount of milk they choose. And also on, you think about on the amount of milk they may choose to produce going forward. You have an ability to go forward and protect milk you're not producing today, but that you intend to produce later. So really nice option there as far as availability goes. Along that lines then to liquidity. This product is going to be offered daily, of which we'll get a stated price for these certain levels of coverage, 70 to 95%, and you pick how you want to do it. You're going to be able to do as much volume as you want at that specific price. So when you start thinking 3 and 4 and 5 quarters out, you're talking into 2020 when this thing launches, we're going to have an ability to use products through this program, such as class 3, class 4 components, all the way out that far, creating a really nice pool of liquidity for dairymen as far as being able to get the amount of coverage they want done all at that price. The last thing here, and I think very, very important here, is cash flow. For anyone who uses the CME, you certainly realize when you're buying options that premiums due up front, no matter how far out you go. With this program, it is sold quarterly. Okay, that makes it different. It's not a month at a time. Guys have to do a quarter at a time, Q1, Q2, Q3, Q4. However, those premiums for each one of those quarters is not due till the end of that quarter. You actually have within 60 days after the quarter's over. So for example, on October 9, when this thing launches, if a dairyman chooses to participate in hedging, say, Q1 of 2020, the premium for that quarter, no matter how much milk he decides to hedge, will not be due until the end of the quarter 2020. So just some really, really nice incentive here for us cash flow wise, knowing those premiums aren't due till the end of each quarter. Last piece of cash flow that is friendly is there is a subsidy here. So the government, once the calculators are out and we're running, what the certain levels of coverage cost per hundredweight, there's a subsidy that ranges from 44 to 59%. 44% matches up to 95% coverage. 95% coverage level, that's the highest coverage a dairyman can put on, which is essentially they are using CME prices for the price aspect of this program. So they would take, for example, the average prices today of January, February, and March, of which then the dairyman on a revenue basis, the best he can do is protect 95% of that. So in today's world, 2019 prices are trading around $16 if we're referencing class 3. 95% of that price is about 15 and a quarter. So that would be the price level of coverage, kind of the highest level we could get in this environment. To kind of stem off that, another big piece of this that I want anyone watching this to understand, this is revenue protection. So there is a yield factor. Okay, this isn't just price coverage. And that yield factor, much like crop insurance, how that will work is the RMA is going to project a milk per cow yield for every state or region in the United States. So for example, let's say the state of Michigan, where I'm from, they will project yield per cow as a state average 5 quarters forward. And an example of, say, Q1, let's say they're projecting 5,000 pounds per cow. Okay, that is a number we can't control. The dairyman can't control. It's just going to be stated what it is. That is their forecast. Now, at the end of that quarter, the USDA through NASS, the NASS Milk Production Report we all look at the end of every month, they're going to use that to produce actuals. So at the end of that quarter, whatever that actual average is, let's say it's 4,800 or maybe it's 5,200, that difference then is going to be applied to the revenue protection, exactly like how crop insurance would work. So there is a yield factor here in this program that very much matters when looking at how this works. It's not as simple as I protected this price and that's where my coverage is. There's a yield factor that needs to be paid attention to and understood.
Well, thank you very much for that overview. How does a producer determine if this program, with all its flexibility, is right for his or her operation? We've got folks that are signed up with MPP and others who are involved in other risk management programs through their co-op or even through your organization. How does a producer kind of evaluate whether this is a good fit or not?
So I think the most obvious answer right now is educate yourself. Get educated on how this works. I hope today's video will be helpful for many on some of the moving parts. Work with someone like us at Rice Dairy Risk Services. There's a few moving parts here, but understand, to me, before you can make any decision on where you should go, understand how they all work. To me, this is another tool in the toolbox for risk management that we have today. We've got using the CME. You've got hedging through a cooperative. You mentioned MPP, LGM. Now we have this dairy revenue protection, dairy RP. I think there's going to be a time and a place to potentially use maybe all these different strategies with where we sit today. And a big reason why we're talking about this here at Rice Dairy is this program, to me, looks like something every dairyman needs to be paying attention to. And for any dairyman today that is choosing to manage their price risk and understanding this is revenue protection, needs to very much be sizing this up because of the things we talked about, the availability, the flexibility, the cash flow reasons here. Going forward, to me, have this looking highly attractive, especially as you get out into the deferred months, 6, 9, 12, 15 months out. This program, to me, looks very, very appealing for those reasons for a dairyman to use to help mitigate some of this revenue risk they have in unexpected markets.
Thank you, Ryan. As we finish up here, you did mention the new division at your company, Rice, the Rice Dairy Risk Services division of your company. Just take a moment to talk about that.
Yeah, so hopefully many of you already know Rice Dairy has been around for about 16 years and is a brokerage company that focuses on helping companies manage their dairy price risk. On my side of the office, specifically dairy farmers. When we caught wind of this program coming out and walking through how it worked, we found out very, very quickly, like, hey, we're going to have to advise dairymen use this. This looks like a good venue. Me as a dairyman, put my dairyman hat on, I'm going to want to use this for our farm in Michigan. And so for us to really deliver the service we want to for our customers, which is giving the best advice and using the proper platforms, we realize this is a market we need to become a part of. So Rice Dairy Risk Services is our insurance agency branch we formed in order to be able to sell these insurance policies to our customers. So when it comes time to, you mentioned, why should you use it or when should you use it? When it comes to us giving the advice and working with dairymen on when and what to do, we're going to be able to do that alongside also being able to use the CME or the co-op or still using MPP. So really trying to be a one-stop shop, not putting ourselves in a siloed environment where we can't execute in a certain arena just because we legally aren't licensed as insurance agents. One thing I wanted to note here too, I didn't touch on it much, but I do see this program working very, very well alongside the CME. For those who are already hedging with it, we see some strong opportunities to use dairy RP in congruence with the CME or with your co-op and some of the hedging you're doing there. Basically using this revenue protection program as your put and using it to create your floor for your revenue, and then using potentially other structures to help finance and work around that stuff. So we here at Rice Dairy Risk Services are really excited for this program. Want to get dairies educated on how it works because we do think this is a really useful tool for them to use in the future.
Well, thank you very much, Ryan, for talking about this. We've been talking with Ryan Yonkman of Rice Dairy LLC, talking about the new Dairy Revenue Protection Program. This is Joel Hastings with Dairy Business News, This Week in Dairy.